Hey everyone, today we're talking about becoming wealthy, wealth formulation. My name is Isaiah Goodman, Chief Financial Advocate at Becoming Financial. So much in the industry around finance and money is about wealth management. And I wanted to really just talk about how we call it wealth formulation, help you understand why it's more about formulating than managing. One of the things I like to do, look at the definition of words. If you look up formulate, it says create or devise methodically, kind of like a strategy or proposal. I really love that idea. One of the things I wanted to look at today was what's the difference between wealth management, wealth accumulation, and wealth formulation. So when I look at wealth management, obviously the first thing there, if you get the word or the idea around management, it means that you probably already have some. Most financial institutions, wealth management offices require some sort of a minimum. Some of the minimums that I'm hearing here in Minneapolis are around $250,000. Doesn't mean you're a bad person if you have that. Doesn't mean you're not a good person if you don't have that. But what I hear most often from my clients is, how do I get there, right? If somebody already has $250,000 of investable assets, they're doing something right. They've either worked a long time and saved money, or they've made some really good decisions or investments. So for them, it really is about wealth management. I need to manage the wealth that I've already grown, the wealth that I already have. For a lot of my clients, it's where do I start? And so it's not as much about wealth management as it is as where do I begin? How do I do this? The other big thing too when it comes to accumulation, so wealth accumulation is often a term that I hear, is it comes from the word meaning to heap. So to accumulate is like heaps and piles, right? And that's very much what we have in the US society is their pile is bigger than my pile. And that's not something that I'm trying to be about. You know, I'm all about the idea of abundance and growth, and really want to help people accomplish their goals. And I think that everybody can accomplish their goals. So this idea of wealth accumulation, I get what they're going for. They want it to grow. They want to help you build your assets, just like I do. But again, it implies this idea that there's one pile over there for all of them, and maybe my pile's not so big. And a lot of times what we see too is, in order for my pile to grow, that pile has to get smaller. And again, we're not about that. What we want to do is help formulate. So again, if you look at the word formulate, to devise or devise methodically, it implies a process. There's steps that we're going to take. It's a strategy, it's a proposal, it's a plan. And that's what we're all about. We want to be able to think about how can I formulate my wealth? In 1 year, I want to get from here to here. In 3 years, I want to get from here to here. In 10 years, here's where I want to be. Again, a little bit of accumulation, but you're not taking away from anybody. You're just trying to build and formulate what you have. Another really good idea or kind of connected word that I love is to shape or to mold. So if you think about a potter or somebody who works with clay, they formulate and they build their sculptures or their pots. That's what we want to do with your wealth. How can I build this thing into something that looks and feels good to me? Because whatever that person builds or creates with their pot, it might not fit what I need for my uses, right? So think about it that way too. As you formulate your wealth, it needs to be something that fits your goals, fits your needs. So I really like to think about wealth formulation. Now, again, when you think about how, we can talk about that in other videos, but I have a couple ideas here in terms of how do you formulate wealth and where do you begin. So if you look at sort of this curve of wealth management, wealth investing, wealth formulation, whatever you want to call it, I'd say formulation. I kind of look at it in a curve. So one of the first things we want to start with when it comes to wealth formulation is short-term, safer investments. So just start somewhere. Put money in a piggy bank, put money under your bed, put money in the bank, hopefully. Somewhere that's safe, short-term, and liquid. You can get to it. Now, you might not get a good return for that because if you go to the bank and you're able to take the money in and out, they might not be able to give you a good interest rate. But it's short, it's safe, you have access to it. Next is more of a middle term, but still safe. So maybe you're thinking about bonds or you're thinking about real estate that's not as risky. You have a little bit longer time frame, 10, 15, 20 years but it's still a little bit of a safer play. You're not going to see your money going up and down. It's still a little bit more conservative. So that's where you get to things like bonds and treasury bills and all of that. Last thing on the top sort of spectrum is long-term safe. So this is where we start thinking about things like life insurance or annuities, pension plans, if you have access to one of those. How can you create this environment to where 30, 40, 50 years from now in retirement, you have some money that's going to be there for you? Whatever you might think about Social Security, if it's going to be there, if it'll be there late in your life, that's what I think is the years might get pushed back further and further. Whatever your beliefs are on Social Security, I wouldn't call that a long-term safe. That's kind of uncertain, right? So we want to create some long-term certainty to start thinking about where can I warehouse some money that I can access in retirement, but is still a little bit more conservative. Next, as I kind of look at my curve, I move to long-term aggressive. So this is our traditional retirement. So as you kind of follow me, I've done short-term, middle-term, long-term, safer. That's how I formulate wealth. Now I'm moving towards the long-term and thinking of retirement. So now we're investing in ETFs, stocks, mutual funds, things that are going to give us a little bit better interest and growth. So long-term aggressive, but there might still be some volatility. And so because we have a longer time frame, 20, 30, 40 years, we can deal with the ups and downs. So we know we've got a safe base. Now we can start to be a little bit more aggressive in the long term. Now I move towards the middle term and aggressive. So this is where we start to think about things like loaning money, business ventures like business capital, really starting to think, I have a little bit longer time frame. I know my other areas have been taken care of. I've got some safe money. I've got some long-term money. Maybe I can invest in this idea or whatever this property is or this business and make some money in the next 5, 10, 15 years. So it's still a little bit of a midterm, but there is more risk. The last thing I'd recommend when it comes to this investment or wealth formulation curve is short-term and aggressive. So this is where we look at things like day trading, Forex trading, being able to even bet or gamble. That's where you've pretty much taken care of everything else, and now you're trying to really capitalize and make some short-term, quick wins and be very aggressive, right? So if you go gambling, you can either hit it big or lose it. If you've already taken care of those other areas and now you're just kind of gambling for amusement, I'm okay with that. If you're gambling as your midterm money that you need, it's probably not going to be a wise decision. So really thinking about, I've covered all my other areas. I'm able to take a short-term aggressive risk because I don't have to worry. So again, things like day trading, if you pick the wrong stock at the wrong time, you might lose some money. Short-term aggressive risk. Forex trading, if you pick the wrong money to trade and they change a law, you might lose some money. But again, thinking about formulating your wealth, you've already been prepared for your short, middle, and long-term safe, long-term and middle-term aggressive. So now you're able to take a little bit more risk with your money. Now the biggest mistake that I see is people start with the short-term aggressive. They're like, hey, I've got $500. How can I turn this into 10,000? You can't, not at least safely. You want to start the right way and formulate and build your wealth.